Okay, good afternoon, ladies and gentlemen. It's showtime. My name's Richard Lowe. Thank you all very, very much for coming along this afternoon. I'm interested. I've just, a little bit about my background. I'm originally from Oxford, England. In fact, there's somebody else in the audience who's also from Oxford, so it's a small world. I've lived in Asia, actually, for now 32 years. So over half my life has been in Asia. 2 of those years were spent in Hong Kong before the handover, that was 93 to 95. And the last 30 years have been spent in Singapore, where my family and my 4 children were born there. They've gone to local schools, they're Eurasian. So Asia has really become, my home. And although I love the UK, which is where I'm from, really over the years, Asia and Singapore has become my home. The first time I came to Bangkok was when I was a backpacker, soon after my student days. That was 35 years ago. And I just cannot believe the changes that we've seen in Bangkok. I mean, 35 years, I agree, is a long time, but it's come from a city that was emerging to a city that is quite incredible when we look at the infrastructure these days, the incredible buildings that we have, not only the W Hotel, but an impressive building behind. I think it's the Ritz-Carlton residence, or at least part of it is, which looks like a Jenga or Lego set just behind us, and many, many other buildings. First times I was coming to Bangkok, there was no BTS or metro. Traffic was really bad. I'm kind of think it's bad, but I'd be interested to hear you. Is it as bad, or has it got better with the infrastructure improvements?
Less bad.
It's still bad, is it?
Less bad.
Less bad. Okay, well that's good news. So the infrastructure sounds like it's paying off. So I'm really glad to be here in Bangkok. It's actually my first event for many years here, and so yeah, it's a joy to be back in this part of the world. Now, I kind of want to just get a sense of the audience today. I never like to take things for granted. We've got a mixture of local people, and we've got people from different parts of the world. I think we've got Germany, India, Canada, UK, and maybe some other countries that I've missed out as well. But can I just get a show of hands who has actually been to the UK? Okay, just keep those hands up because it just kind of gives me a sense. So don't be shy. Okay, about half the people have either been, and I know 1 or 2 people are actually from the UK, so that's pretty obvious. Okay. Who's actually lived in the UK? Okay, a couple of people there. Alrighty. Of course, if you've been born there, I'm sure. Okay, maybe a little bit more sensitive, but again, it just gives me a sense of the room. Who's actually invested in the UK in the past? Okay, we've got 1 person. Okay, all right. Help me out as well. Okay, so one of the things I find when I speak with audiences, I've been working in finance and real estate since 2008, in developer financing, pure finance, international real estate, project marketing, and Turn-Keyinvestments provides a wide variety of real estate investments. Today we're going to be covering and focusing on UK government-supported social housing and supported living. Every so often it's cutting out, sorry. Which is an asset class I found that many people in this part of the world have never heard of. Usually what you find in this part of the world is one of the large developers in the UK will appoint a real estate agency, and they'll be marketing a very nice new build, shiny building, where you'll buy generally off-plan, get a rental once it's completed. Hopefully over the medium to long term, you get a capital growth, and at some point you may wish to sell it. There may be other reasons that people are investing in the property there. I find in Asia it's quite common that parents buy a property in the UK because their children are going to be studying there. They may wish to diverse their real estate portfolio and invest into a country outside of Thailand. But one of the barriers that I found to people investing in overseas, outside of their home country, in this case the UK, is the fear of the unknown. If you've never traveled there, or you've never lived there, or you've never worked there, I think human nature is such that, well, I'll invest in where I know. My challenge to that is just because you know it, and I'm assuming that those of you who are from Thailand and Bangkok, you know the market here, although it sounds like it's been doing very well, just because you know Bangkok, does that mean to say it's the best place to put your hard-earned cash and get the returns that you're expecting? And on that note, I'm going to just throw this out, because can you guys give me some feedback? How has the residential market been going in the last sort of 4 or 5 years? Can people give me some feedback? How is the residential market here? Are the prices going up? Are they fairly flat, or are the prices been going down? Just in the last few years.
The price is going up. I have seen last 2 years.
Last 2 years, prices going up? Okay.
It depends on which place. Like if you're staying on the town or like town Lowe area, prices are going up.
Okay. So it might be that certain areas are performing better than others. I think that's quite common within real estate. But would it be correct in saying that the general trend at the moment of Bangkok property prices are going up? Yeah. I had heard some years ago that there was a bit of an oversupply at one point, and that there were lots of properties on the market, and maybe it was a bit flat. So it's good to hear that things are taking off again, and the market seems to be picking up. So if you've invested here in Bangkok, it makes sense. If you live here, I would always encourage people generally to invest or buy a property that is your primary residence. But when it comes to an investment property, you really want to be thinking clearly, what is it that you want to achieve from the investment property? What risks are you comfortable to take when investing, let's say in this case, outside of Thailand? What sort of yields are you looking at? What kind of capital growth would you hope to achieve? And ultimately, what kind of return on investment would you like on the cash that you've actually put into that property? And so coming kind of like from my sort of financial advisory background, I look at these very much as a hard-nosed investment decision. And today what we're going to be covering, as I say, is UK government-supported social housing and supported living. In fact, we're going to be covering 2 different ways to invest into this asset class. Now, can I just have a show of hands? Was the first time that you heard about UK social housing when you saw an advert or an email that I'd sent to you? Just put your hands up if it's the first time that you'd heard of UK. I find in Singapore, where I've done lots of these webinars and seminars, that I would say probably 90% of the people have never heard of UK government-backed social housing and supported living. So don't be shy in that. It's a very new area. But if you're a client that is looking for low risk, high yielding, and in some cases inflation hedged long-term income, these are very, very interesting, as you'll see as we go through the presentation. But you might want to ask yourself, first of all, let's just look at a macro level. Why invest in the UK? Well, I previously mentioned maybe having some diversification. That's always good in a balanced investment portfolio. Maybe it's for a specific reason that your children are going to study there, and you'd like to buy them a property and have them in a nice property whilst they're in their studies. One of the things that makes the UK property market very attractive, it has a very strong track record of consistently delivering growth over time. And this is really because there is a major undersupply of properties in the UK. No government in my lifetime has been able to address this. In fact, the UK government previously said that the UK needed to deliver 300,000 properties every single year to be able to keep up with the demand in the UK. The best year they've done in the last 30 years was about 250,000 properties, and the average was about 169,000 properties. Now, the Labour government have come into power just last year, and they have, dare I say, made a promise to build 1.5 million properties over their next term, so over the next 4 years, which basically means they're going to be needing to build just under 400,000 properties every single year. Well, no government's achieved that. So I think it's a very bold and courageous promise, but I think very skeptical of whether it's going to be achieved. So when I talk about track record, let's actually look at some numbers here. So here we can actually see the London Price Property Index going back from 1990 to just past 2020. When I first saw this graph, it kind of blew me away, because in my lifetime, back in 1980, the average price of a London property was about £15,000. The exchange rate with the Thai baht to the pound is about 42.6, I think. I was looking at it just yesterday. Closer today, we're looking at just under £600,000. So very often I find clients, they always want to get the best deal at the best time and the best price, and I get that, that's human nature. We all want to make sure we've got a great deal. But actually when you look at this graph, it's pretty steady, and actually time in the market tends to be, the key thing for long-term capital growth. Now here, this is the biggest dip since records began in 1960. And prices of property across the UK actually dropped by about 17 to 18% on average across the UK. Any guesses to what might have caused the biggest drop in UK property prices since records began? Any guesses? Not Brexit, no. This was in about 2008, 2009. That's a clue. Yeah. The recession, or the global financial crisis. So in the UK, that did have an impact on property prices. We can see it here. But nothing like as bad as some countries. Some countries really, went down 30, 40, 50%. Singapore tends to be a lot more volatile. When I do comparisons between the Singapore property market and the UK, Singapore's like a roller coaster. I mean, if you get in at the wrong time, it can be a very costly mistake. Within the UK, of course, again, we always like to get it in at the bottom of a cycle, but time in the market shows you here that invariably you will make money over the medium to long term. Now this is actually a similar graph, not over 40 years, but over 25 years, showing the average UK. The previous one was London, this is UK. So back in 2002, the average price of a property across the UK was just over £100,000. And today, well, almost today, we're close to just under £300,000. So almost tripled in price on average across the UK in the last 20 to 25 years. So I actually involved with all kinds of UK real estate investments, from what I call a traditional property investment, where you may be buying off a developer or even in the secondary market, owning that property, getting a rental income, and at some point, if it's an investment property, probably wanting to sell it for a capital growth and make a nice profit. And I literally have hundreds of those properties all across the UK. But again, my guess is most of you will have heard of that kind of investment. It's probably the most basic strategy for investing into real estate. But today I'm going to be sharing a different way to invest into a different kind of asset class. It's still real estate, but in this case, it's UK social housing and supported living. So I'll go into a little bit more detail, but just to give you an idea, for people that have fallen on financial hard times, UK social housing allows them to have a free house which is effectively paid by the government. And many people, when they first hear about this, they look at me like I'm a little crazy or an alien, because in Asia, generally speaking, they're not welfare states. If, let's say somebody has a problem, it's very nice, but it's usually the family that gets together and looks after that person. So if it's your parents, then very often, if they don't have a retirement income, it's very often the children that will be looking after the parents and making sure that they still have a quality of life and a roof over their head. Now, the UK is what we refer to as a welfare state. In a welfare state, typically taxes are much higher. Now, can you just give me an idea, again, just so I understand, what is the income tax here in Thailand? Is it on a sliding scale or is it exactly the same? Just, if you can just give me an idea. It's on a sliding scale. What's the lowest income tax? Where does it start? 5%.
Maximum is 35.
And the maximum is 35. Thank you very much. Okay. Singapore, one of the nice things of Singapore, albeit a very expensive country, we get whacked with taxes in kind of different ways, but income tax is from 0 to a maximum of 22%. And probably, 10 or 11% is quite normal to pay. Well, in the UK, the starting entry level for income tax is actually 20%. And then it doesn't have to go too much higher to hit 40%. So you're very quickly up at 40%, and the top tier at the moment is 45% income tax. So people who are working in the UK get hit with large taxes, but those taxes are used, well, they should be at least, for providing free services or subsidised services, which includes things like healthcare. So we have the National Health Board in the UK, which actually provides free healthcare. Now, it may not always be the fastest healthcare, unless it's a very urgent requirement, but it's free. Education. We have state schools, which is free education. And as I mentioned before, there is actually free housing for people that do qualify for free and social housing. Now, social housing isn't something that's just happened recently. It's actually been around for about 100 years. So it's not a policy that's just come up in the last 2 or 3 years. It's something that's been around for a long, long time. More recently, a law, we call them acts, but in 2018, something called the Homelessness Reduction Act, which is actually now made a law in the UK that if you can no longer afford to rent a property, or if you had bought a property and you can't service your mortgage and you are evicted or can no longer stay there, within something like 57 days, you can go to your local government and apply for social housing. So you actually have a right to have a roof over your head if you are in the situation where you may lose your home. And again, this is for approved individuals and families that qualify for free housing. Let's look at some of the macro data around social housing. So UK social housing shortage per annum is at 90,000. In 2000, I think it was in 20, the number of new social housing properties built was about 6,000. So we can see per annum, 90,000 required, only 6,000 delivered, and it hasn't really changed much over the years. What is a very, I suppose, frustrating thing, probably for the government, is that there are over 261,000 empty homes. These are homes that have either been abandoned, maybe the people who lived there have died, they didn't have anyone to pass it on to. There are a whole variety of reasons, but it's quite amazing. 261,000 homes which are sitting empty, yet every year, and this is just the social housing. Remember I said earlier, the government had estimated the UK needs about 300,000 properties every single year to fulfill the actual demand. Now, this is a very sad statistic that last year there was an increase of 140,000 homeless people in the UK. And again, I say this because I look at a country like Thailand that has come so far. Now, no country is perfect, no government is perfect, but it really has grown and economies have improved, and it looks like the overall quality of life has significantly improved in countries like Thailand. And so if you haven't been to the UK, it's not perfect. and there's a lot of socio-economic challenges. The US actually has thousands of homeless people as well. So sometimes we look to the West and think everything's perfect, but it really isn't. And in fact, when I look at places like Thailand and Bangkok, it really is, again, incredible the changes in the positive way that appear to have happened in society. Now, if you actually qualify for a social housing property, you're not guaranteed to be able to get into one because there's such a short supply. So the actual government puts people on a wait list. And if they're on a wait list, bear in mind I said from about 57 days, if they're entitled to free housing but they can't get into a house because there's nothing available, the government will pay for short-term accommodation. And short-term accommodation typically is hotels and sometimes serviced accommodation. So this is temporary whilst waiting for a more suitable apartment. Because bear in mind, if you're a family, 3 or 4 people, and you're living in a hotel room, that is not a conducive environment long term. Now the problem for the government is that last year alone, it cost them 1.7 billion on the actual rent for these hotels and serviced accommodation. To put that in perspective, it costs roughly about 5 to 6 times the price per night to house people in a hotel compared with a purpose-built social housing property. 5 to 6 times the amount. So the governments are highly motivated to find more social housing because ultimately it costs them a lot less. So there is synergy in terms of looking at how to reduce the costs for the government and at the same time provide a more conducive living environment for those in need. Now, with social housing being an asset class that is often referred to as something with low risk, high yield, inflation hedge, long-term income, many institutional investors look at this asset class because they get predictable income. Insurance companies, hedge funds, they're looking for predictable long-term income. This is just an example of a few institutions that have invested into this asset class. Recently, a company called CK Asset Management, which is actually, if you've heard of Li Ka-shing from Hong Kong, very famous Taipan or businessman from there, bought a social housing operator, and I'll go into what that is in a moment, called Civitas PLC in June 2003 for £485 million. Since then, I'm told that he's actually invested in now about £3 billion worth of UK social housing for the reasons I've just mentioned about good long-term, low-risk, inflation hedge predictable income. So I'm just going to read this bit just because I want to make sure it's as clear as possible what social housing and supported living is. So, social housing and supported living property investments are a public and private property asset class. Investors own the freehold property and they lease or they rent the property to a regulated and registered social housing operator, often referred to as a housing association. And this housing association, think of it in layman terms as the property management arm of the local government. And it's actually this housing association that's the tenant. They place the vulnerable people in the properties, but those people are not the tenants. They are the benefactors of social housing where the government is providing a free house for them. But the person that is, or the entity or the company or organisation that is the tenant is the housing association. Now, a housing association, there are only limited housing associations. They are regulated and it's very difficult to get a housing association licence. These are regulated by the UK government, and it is the housing association that I say is your tenant. Now, the housing association not only rents the property, but also takes care and a full responsibility for property management, repairs, utilities, void periods, so that means when somebody's not actually living in the property, and provides support or care services to vulnerable people who are living in the property. And below here, we can actually see a few different kinds of people. In fact, let me just categorize. There are many different kinds of social housing. One of the main ones is people that have fallen on financial hard times. They can no longer afford to rent or buy a property. And if they qualify, they can get a free roof over their head. The developer I'm going to be sharing with actually provides social housing with supported living. Now, when we add on supported living, this is because the people actually in the properties are not only having financial hard times, but they're special needs people or families. It may be physically handicapped, mentally handicapped. It might be a war veteran coming back from post-traumatic stress disorders. It could be domestic abuse survivors. It might be orphan children. It could be elderly people who need support and care facilities but don't have any other immediate family to look after them. So there are many, many kinds of supported living groups of people that actually depend on this social housing. In fact, at the moment in the UK, there's approximately 8.5 million people that depend on UK social housing. So how does the rent flow? So if you were thinking about investing in one of these properties, how does that money come to you? Well, central UK government last year had a budget of around about £25 million for rent for social housing across the UK. That's £25 million. Central government then forwards this to local authorities or the local government. In turn, the local authority or local government sends that to the housing association, which I've mentioned before is the tenant that you go into a contract with, who pays you, the property owner. So ultimately, as a property owner, the funding that's coming from the rent is from central government. Bearing in mind, this kind of asset class has been around for 100 years. It's not, a fly-by-night situation. It is addressing a very serious need in the UK for free housing and supported living from special needs people. So what I'd like to do on this chart here is actually compare some of the differences between owning a property in what I call the private rental market, a buy-to-let. So a buy-to-let property is often used in the UK for an investment property. You've bought it, you're renting it out maybe to a student, maybe to a young working professional, maybe to a family, but you're renting it out into the private rental market. We've established that social housing, basically you're renting that to a housing operator, which is funded by the UK government. But let's have a look at some of the differences. If you buy in the private rental market, all the repair and maintenance costs are borne by the landlord. You have to pay for them. But with social housing, the tenant pays. That is the housing operator or the housing association. Finding occupants. Generally, that's the landlord. If you're in Singapore, very few people outsource this. They often take care of it themselves, which can be quite time-consuming. If it's an overseas property, they may well appoint a property management company to take care of that. Again, with social housing, the housing association is the one that puts the approved individuals and families into the properties. All the certificates and building compliance, ultimately the landlord is responsible, in this case, the housing association. Rental occupancy. Now, in the UK, and particularly in London, we've had a very, very strong rental market. And if anyone owns properties there, you'll have found probably that you've got a good rental coming in, and the void period, when it's empty, literally within a week or so, you can have a tenancy changeover. So it's been a very strong rental market. But economies go up and down. And at the moment, with such a short housing supply across the UK, there is a huge demand, coupled with the fact that with interest rates going up, the mortgages are expensive, so many people are being forced to rent. Now, we are just starting to see interest rates coming down, and with those interest rates coming down and a lot of people paying very high rents, I think we're going to start seeing a softening in the market where the rentals start to adjust. My point is this: your rental could go up when the market's good, but when the market's weak, maybe your rental will be coming down. And that you have absolutely no control over. With social housing, basically, it's a 100% occupancy. There are no void periods. In fact, the rental agreements are typically up to 25 years with no break clause and start from the day that you have completed the purchase on your property. What is the rent source? Well, generally it's individual tenants or families. Ultimately, this is perhaps not quite right. The housing association is the tenant, but the UK government fund the property. And the usual tenancy length in the private rental market in the UK is usually 1 or 2 years. And every time you change the tenant, you're going to be finding you're paying a finder's fee, maybe a negotiation fee, possibly a rental void. And if the market's soft, rather than being a week or so, who knows? You might find yourself going through a few months of a void period. One of the challenges sometimes in the UK, and it's very rare, but it does happen, is that you rent your property and for whatever reason, your tenant stops paying. And if you don't have tenant's insurance, which you can get, and that will cover basically for a tenant that stops paying, and even legal fees to evict them. But if you didn't have that, it could easily take 6, maybe 12 months to evict somebody. If they're not paying rent, you're still probably paying a mortgage. So you've got outgoing expenses with no income coming in. Again, here, 100% occupancy rate, no void periods, no risk in that respect. So really what I'm trying to say is that with social housing, you still own a property, which in most cases is a freehold property, but you don't have the associated risks and variable changes that are out of your control that you do have in a private, in the private rental market. Does that make sense? Just kind of put your thumbs up if that kind of is clear, because I'm just conscious I'm speaking in English. Thai is very difficult, and I apologise that I don't speak Thai, so I just want to make sure that everyone's with me. So please, if there's anything that's not clear, I should have said this earlier, don't hesitate to put your hand up, don't be shy, please do ask the question. So I'm going to speak a little bit about yield investing. It's a strange name, but that's the name for the developer. So the developer that I have been working with for about 4 or 5 years, if you were interested to invest and buy one of these properties, they're called yield investing, and they call themselves yield investing because their properties are very strong yielding properties. Now, for those of you who saw one of the videos earlier on, these guys basically, their business model is they've established relationships with various local governments. Again, we sometimes call them local authorities. They go to those local authorities and having built a relationship, they ask them, where do you need social housing? And it might be specialist supported living. So it might be somebody who is severely physically handicapped. And the fitting out of that kind of property needs to have very special attention to detail for physical handicap. So they go to the local authority, say, where do you need social housing supported living? They tell them the towns and cities which there is the highest demand or an immediate demand, and they then go out and typically find these old abandoned properties, buy them at bargain basement price, and give them a brand new renovation, and then working with the local authority and the housing association that's with that local authority, they then put together a long-term rental agreement, typically up to 25 years. So when you buy the property, you're buying a property that has been brand newly renovated, and it comes with a lease or a tenancy agreement up to 25 years with no break clause. So it's a very interesting asset class. So maybe I've jumped the gun a little bit here, but so I've just mentioned newly renovated and furnished properties is what you would receive. A 25-year commercial lease with full repair and insurance with no break clause and no void periods. Let me just explain a little bit of difference between a normal residential lease and a commercial lease, because a commercial lease is usually associated with a commercial building or a business. So I saw there was a Starbucks just around the corner in the neighbouring building. They would basically have a commercial lease. Generally speaking, in a commercial lease, the tenants, let's say that's Starbucks, whoever the owner of that Starbucks is, they're the ones that have to pay for all the repair and maintenance. But it is in a commercial, like office space building. So the thing that might sound a bit strange here is that this is a residential property, but it actually has a commercial FRI lease. FRI means full repair and insurance. So pretty much in layman's terms, there are no additional costs to you as the landlord. So your net yield, you know exactly what you're going to be getting. In fact, most of the properties start at 9% net yield. That is, the only other cost would be tax, which varies depending on how much income you have in the UK, and an insurance policy, which is about £375 a year. That would be pretty much it. So you're looking at a 9% net starting yield. The landlord never pays or deals with repairs, maintenance, tenant damage, utilities, rental or letting fees, management fees, or void periods. And hence, we call it like an armchair investment or hassle-free, because you own the property and every month you get an income and you never have to deal with the people in the property. You never have to be worried about a void period. You never have to be worried about a tenant not paying you because of the way this investment is set up. Now, every year, and this is written into the tenancy or the lease agreement, the rent is adjusted upwards based on inflation. So this is an inflation-hedged investment. Now, the UK has averaged, over the last 50 years, about 2.83 inflation rate. Now, a year or two back, it did actually go up to just over 10%, which was pretty high. It's now back down to just over 2%. But what this means for you is every single year, the rent will go up in line with inflation. There is a maximum increase, which is 4%, and it will never go down below zero. So you know, your rent is never going down. The UK has never had negative inflation, by the way, but even if it did, your rent would not go down. Now, with this investment, the developer not only will sell it to you at the beginning with all the benefits that I've mentioned, but every 2 to 3 years, they go back to the investors and they'll say, would you like us to buy your property back off you? It's not mandatory, you don't have to, but it's an option whereby they will go back and ask, we will be willing to buy the property back off you and we'll pay you an additional 10% of the purchase price. So if you imagine after 3 years of owning a property, you have been getting a minimum of 9% net yield, times 3, that's a 27% yield you've had in 3 years, plus another 10% that they will pay you over and above the purchase price. That's a 37% return in 3 years, which is just under 13% per annum, in what many people would think is a low-risk, high-yielding, long-term income investment property. Now, interesting enough, for clients that actually own multiple properties or maybe even a small block of properties, if you owned a portfolio of properties more than £500,000, when the developer does the buyback, they will actually treat you a little bit like a partner, and the estimated uplift would not be 10%, but is projected at between 20 to 30%, depending on what they sell the property onto. Now, the reason I say that is, why are they interested to buy all the properties back? Because actually what they're doing is going to resell it a second time. They're going to put all the properties together. In English, we would say, we're going to aggregate all of your properties. And what they have done is they set up a sale to an institutional investor. I mentioned earlier, this is very, very interesting to institutional investors because of the low risk, high yielding, long-term inflation hedged income. So a few points to consider there. Now, I might have to say here, you're not buying Buckingham Palace, okay? If you're buying for ego or looks or nice new shiny buildings, this is the wrong investment for you. If you are looking for something that is low risk, high yielding, inflation hedged, long-term income, in my many years of working in investment and real estate, I have not come across something that offers such an attractive return. But they're not glamorous, but they make some very good income. So, look at the entry-level prices. Many of these properties are in the northeast of England. So again, if you're not so familiar, maybe you've heard the Football Premier League, Newcastle's up in the north, Middlesbrough, Sunderland, Durham, Hartlepool. The developer focuses in this part of the UK because this is where actually they get the highest yields. And what they're looking for is income-generating investments. And as a big bonus, unlike the price of a property in central London, these properties start actually at about £75,000. I'm just taking an example here, one at £98,000, which is about 4.2 million baht. Comes typically with a 25-year lease. The total rent in the first year is 8,820, which comes to, I should say, a 9% net yield, which in Thai baht is about 379,000. The monthly rental is £735, or about 31,500 Thai baht. Now I'm going to ask you a question, and this obviously could differ from one person to another. But in Thailand, how many of these properties would you need? Let's say you're getting close to retirement and you want good, steady, safe, long-term income. How many of these properties would you need in order to have an income to retire on? Are you going to answer me there? 5, okay. It may be 3 for one person, 10 for another. It depends on what sort of income that you perceive that you need. But I think the point is actually, for your average man in the street, probably not that many properties in order to have a very secure long-term income stream for retirement. So think about this as potentially a retirement plan where you could be building up over the years multiple properties. Now, I've mentioned in year 1 rent is 8,820. What we see here is the compounding impact as the rental is adjusted based on inflation each year. Now, I do have a graph, and I think you might even have one in your handouts. By year 10, most of these properties, if they've started at a 9% net yield, by year 10, the accumulated rent that you will have received will be equal to or just more than the price of the property you paid for. So within 10 years, just the rent, not the capital growth, just the rent would have paid back the purchase price of the property. Now, I mentioned, most of the tenancy agreements or leases are up to 25 years. By year 25, based on this average compounding inflation increase, you're then looking at over £17,000 per annum of income. Now, over 25 years, you would have accumulated over £300,000 of rent, which is actually purely on the rent of 311% return. So you'll have paid for your property 3 times over in the course of 25 years. Again, not including the capital growth of the property. When we saw the chart of the average price for a property over the last 20, 25 years, it pretty much tripled in price. So you've got a nice big icing on the cake if UK property continues, and the trends are very consistent over 60 years. So just look at this, as I say, it's not ego, it's looking at good, sound, steady, reliable investments, which don't take up any of your time or energy. Here's another example. This is a 3-bedroom property, priced at £120,000. That's about 5.15 million. Again, comes with a full repairs and insurance lease for 25 years. Year 1 rent, 10,800. That's about 464,000 baht. 1 month rent, £900, about 38,600 baht. And with an optional buyback at 10% appreciation, you'd be selling that back at £132,000, or about 5.66 million if you decided to participate in the buyback. And again, we can see the figures starting at 9%, increasing basically by year 25, estimated at 17.6 net rent, which gives you a total return on the rent of 302% and a total income of over 25 years of over £385,000. So I think, some pretty impressive figures, especially when I compare. I have a client who I met up with earlier this week, and he's bought multiple properties in London, beautiful properties. But what he has actually found is after he's paid for the property management fees, the mortgage costs, the repair and maintenance costs, he has very little in the way of positive cash flow. And so he's really looking for the capital growth. And when we look at capital growth, we have to look into a crystal ball. We don't know what the capital growth will be in 5 years, 10 years, 20 years. And who knows, it may be at a time in our life where we are short of cash, we're forced to sell, and the market's not doing so well. But we don't know for certain what the capital growth will be. When we look at these income streams, we know exactly what we're going to be getting. It's very predictable. And actually, I perhaps won't go into it today, the valuation of a property on a commercial lease is primarily driven on the rental income. So if your rental income is going up, the value of your property is going up. Also, if you think about this asset class, it's what I call a very defensive asset class in an investment portfolio. And the reason I say that is that when the economy is going down, people are losing jobs, may not be able to afford to pay their rent or service their mortgage. More people need social housing. If you're in the private rental market, the chances are the number of tenants is going down. You may lose a tenant, and then suddenly who's having to pay all of the bills? It is you, the owner. So again, things just to consider. Now, you can argue to say when you've seen these properties, and I've visited quite a few of them, once you've seen one, you've actually seen pretty much all of them. They are brand newly renovated inside. They use pretty much the same carpets, appliances in the different properties. And they do that because they order on scale, and that gives them an economy of scale when they're renovating 30, 40, 50 properties every single month. But if you imagine here that you are somebody who has lost their home and is in a really challenging position in their life, has the opportunity to get a free house, and if they are special needs with additional supporting care, to be able to have a brand newly renovated place like this. And this is something that I truly have a passion for, because this kind of property goes beyond just the bottom line, what's in it for me, even though I believe it's a very compelling investment. But actually, if you were to invest in one of these properties, you are putting a roof over the head of a very vulnerable person or a family that's in a very vulnerable, difficult situation, and having a profound impact on their lives, helping them to get back on their feet, maybe the social support that they need to be able to integrate back into society. So it has a strong ESG component to this investment, in addition to being, a very compelling investment for the reasons I've mentioned. Now, this is an example of the price list. This is changing almost every day. I mentioned before that the entry-level property price is typically about £75,000. They don't have any at this point in time, but it's only a matter of time. They'll have some more around about that price point. But you can see here, 2-bedroom studio apartments, £119,000. 3-bedroom freehold property here is £120,000. 4-bedroom one, £150,000. Let's go down a bit. 6 times studio apartments, £323,000. Go down to the bottom. This is a small block of 14 apartments, which are all 1-bedrooms, at a total of £824. And it goes on. Actually, they have blocks that can go multi-million pounds. So this is an asset class whereby, an individual investor might want to start at the entry level about £75,000, or it may be something whereby you have a bigger budget and you'd like to allocate more funds to this asset class for the reasons that we've mentioned. So this is not an exhaustive list, it's just an example of what is available at this moment in time. Now, if you were investing in owning one of these properties, this is actually the process. Choose your property, complete the reservation form and pay a £5,000 deposit. Then what we'll do is we'll engage you with a solicitor. Typically, we would recommend a solicitor that is familiar with social housing sales and purchase contracts and also the lease agreements that go with that. Transfer the balance, you'll receive various reports that you normally do in what we call conveyancing process as you purchase a property. Transfer the balance to the solicitor, exchange contracts and complete your purchase. And basically the day you complete is the day the rent starts. So typically within 1 month of completion, you'll receive your first 1-month rental. All right, so just to wrap up this section, yield investing offer opportunities to buy and own social housing property. You are the owner, typically, of a freehold property. It's completely hands-free once you've purchased. Once you've purchased, there really isn't much you do. Apart from the annual rent review and an insurance policy, that's it. The housing association takes care of all the other issues to do with the ongoing management of the property and the maintenance of the property. You've got no repairs, maintenance or service charges. The UK government-funded leases are up to 25 years with no break clause. Rents cannot go down, only upwards based on inflation, albeit capped at a maximum 4% increase. What I refer to as very ethical and social impact investing. It goes beyond just a pure bottom line, hard-nosed decision of an investment, assuming that you're looking for a low-risk, high-yielding property, but also has a profound impact within the society and helping people get back on their feet. And an owner of a freehold property offering high yields, low risk, inflation hedged long-term income. All right, might sound like a broken record there, but I hope the message has got through. Okay, now before we go on to the next section, I'm just going to pause because for a lot of people that might be quite a lot to take in just on social housing. So I'm just going to pause for a moment. I'm just going to grab a quick drink and just ask if you've got any questions that I can assist with. Just on this social housing and actually owning the property. Don't be shy. The first person who asks a question, by the way, I always bribe people in certain ways of sorts. I'm going to give a book, actually. I'm just going to get one of the books I have. It's in here. Go. Yep. So the first person who's bold enough to ask a question, and I saw a hand go up there, sir. This is a book called Gold Nuggets for Entrepreneurs, Lessons That Change Your Life. There was a very motivating lady who is sort of like the coordinator of all the authors in this book, and I happen to write one chapter. When she asked me to write a chapter in the book, I sort of scratched my head and thought, well, what could I write about that might be of interest to entrepreneurs and people building businesses and so on? Well, having been involved with sales and marketing for the best part of 25 to 30 years, I thought to myself, well, maybe I can share some experiences in longevity and working in the sales and marketing industry. So I've written a chapter on that. I've also shared some of my thoughts about being an entrepreneur and running your own business. So you were the first hand to go up, so I'm going to provide you with a book. And please, fire away with your question.
You mentioned earlier we could be able to exit through the option to buyback, right? So if we miss that chance, any other way that we can get exit?
Very good.
Maybe after 5 years or 10 years?
Thank you for asking that question, because I have overlooked a very important part, the exit strategies. So, yeah, one of the exit strategies I've mentioned is that if you wish to participate in the buyback with the developer, they'll do that every typically 2 to 3 years. But with this property, you are the owner. You can actually sell it any time you like. So there's no restriction. You could sell it within a year to another investor. You could keep it for long term because maybe it's even legacy planning. You might want to pass it on to children in the future. So there are several ways, as I say. Through a developer buyback, you can sell anytime you want, or you could keep for as long as you like. The choice is yours. Now, with let's say it has a 25-year lease on it, then you would need to sell to another investor. You can't kick out the people in the property. But if you imagine the reason that you bought it was because of, being low risk and high yielding, maybe in 5 years' time, the yield is increased to maybe 10, 11%, so the yield is even stronger. I'm sure there's lots of people that might be interested to now buy your property off you if you wanted to exit. So again, in summary, you can actually sell whenever you want to another investor. You could keep for as long as you like for long-term income, retirement, maybe legacy planning and passing it on to the future generations and children, or you could participate in a developer buyback, which is typically every 2 to 3 years. Any other questions? Yes.
I heard that when the developer buy back from the original owner and then they plan to sell to the institution investment, and so why those institutions not buy from the developers in the first hand?
Okay, so the question there was the developer buys back properties from investors like yourself, aggregates them and sells them to an institution. Why doesn't the institution just buy? Well, actually it does. They frequently are looking at portfolios to buy. So I showed an example with Li Ka-shing, CK Asset Management. They bought a housing association for, I think it was 485 million, because the housing association literally had thousands of properties under management, and with that had reoccurring income. So it's not the only way that an institution would have the ability to buy social housing. Very often they will buy a housing association that already has maybe hundreds, if not thousands, of properties. So there are various ways that an institution could go about buying. Okay. Anybody else? Okay.
Thank you. I'll try to ask this question with some sense of clarity. I'm wondering about the capital gains that is earned within the United Kingdom based on this investment scheme? And do you get assistance for paying taxes as a foreign investor?
Okay, so two different questions. Let me take the first one. So the capital gains is, what would be the potential capital gains? Would that be the tax on the capital gains? Okay. All right. I'm not a tax advisor, and that is a regulated industry, so I have to kind of say that. But just to give you a ballpark figure, if you are selling the property, the capital gains tax at the moment, there is slightly lower on the first portion of the sale, but at the moment, and these laws have changed quite recently, it used to be between 18 to 28%. It's now between 18 to 24% capital gain. Now, there are things that you can use to offset the stamp duties, some of the initial legal fees and so on to reduce it a little bit. But as a guideline, if you were selling, you would be subject to capital gains tax.
But during the rental period, even if you're not selling, those gains for the rental per month are also gains. Do you pay tax on that 9%?
So that would be termed as income tax. That's a different kind of tax. Typically, there are three main taxes when you own property in the UK. When you buy the property, there's stamp duty. There is, while you hold the property, you've got income tax. And when you sell the property, you've got capital gains tax. So the one I just mentioned was about capital gains when you sell. When you hold the property, there is income tax. And I mentioned in the UK, income tax is between the lower level at 20%. When you get just over £38,000 of income each year, you jump up to 40%. And I think now it's above £125,000 of income, it's up to 45%. Now, if you have no other forms of income in the UK, the chances are, if you're just buying one or two of these properties, the income that you would generate would be in the 20% income tax bracket. Now, and this is a whole nother seminar. I don't really want to go down this route, but again, I will be around for a few days if people want a more one-to-one meeting. But you could buy in your personal name, but there comes a point where if you're owning 2 or 3 properties, it may become more tax efficient to buy through a company structure. And then buying through a company structure, there are various things that you can do to offset from your income to reduce that income tax liability. That's a whole nother seminar that I do. And in fact, I usually bring specialist speakers in on that subject. But that hopefully gives some feedback on that. Any other questions? Because I have another half session to do. So yes, madam. Thank you.
Hello, if a foreigner like us want to buy the social housing property, any other restriction or condition we have to notice in law?
Well, one of the beauties of buying and investing in property in the UK is, apart from stamp duty, and only then if you are living in it. So if you're a UK resident, buying property that is what you're going to live in, that would be a little bit different. But I'll give you, I'm a British passport holder, I'm a British citizen. Between you and me buying a social housing property, there would be no difference in terms of costs and associations, okay? So there really is no difference between a foreigner buying this property, or actually just a normal property, if I can use that word, in the UK. There's no difference really between a foreign investor or even somebody who's not British buying a property in the UK. Unlike a lot of places where foreigners in Singapore, you know, believe it or not, if you're yourselves buying a property in Singapore, as a foreigner, you would get hit with a 60% stamp duty. 60. It's incredible. And the properties are very expensive to start with, let alone the stamp duty as a foreign investor. So one of the nice things about the UK is that you're actually treated in the same way as people like myself who are actually from the country. Any other questions? Otherwise, we'll move on to the next section. But maybe make a note of some of those questions as well as we go along, and then once we finish, we'll have another short Q&A as well. Let's go on to the next way that you can invest into UK social housing. And this developer is called the Alderley Group. And the Alderley Group basically build properties for the government, but the government actually owns these properties. Now, the investment here is, it's like a property bond. In the UK, they often refer to it as a loan note. But in simple terms, this developer is raising money and you are lending the developer money, and in return, they will pay you an attractive annualized interest rate. It's a loan. In simple terms, you're lending money to an experienced developer who uses those funds. I'll go into more detail, but I just want to make sure we're very clear. The first part of the presentation is yield investing, and there you are investing, buying and owning the property. Here you're not owning the property. You are lending money to the developer who in return will pay you a very attractive rate of interest. So, the family behind the Alderley Group have been in real estate for about 25 years. So they're very experienced, particularly in the social housing area. In 2019, they created the brand of the Alderley Group, and basically this is actually showing the growth just in 2024. There was a 63% increase in the number of developments or projects they did. 2 imminent handovers, that means 2 properties just about to complete and the keys handed over to the government for people to be able to utilise. They've built over 900 units. They've increased last year, sorry, that's 900 units just last year, 7 new partnerships with different local authorities, a 200% increase in completions. They're now developing in 4 new regions of the UK. What we call Investment 3 series is actually the name of the bonds. They call them Series 1, 2, 3. In fact, we're now into Series 4. And we have a fact sheet inside the information we've given you. I think it's towards the back of fact sheets that gives some of the main terms and conditions of the property bond. And the Alderley Group last year actually won 5 or awarded 5 nominations. So let me just share a little bit about the Alderley Group, because when I first heard about their business model, I was truly amazed at what they've put together. A traditional developer, and what I call a traditional developer in the UK, might be making a 15 to 25% profit margin. But what they'll be doing is they'll go out, find a piece of land, typically have to they will have to get planning permission, which sometimes can go backwards and forwards and slow things down tremendously. Then they'll need to build the property, construct it, and then depending on the market, they're trying to sell the properties and hopefully make a profit. And if the market's rising, then hopefully they're making a good profit. If the market's going down, then maybe they're struggling to sell, maybe their cash flow's getting hurt, maybe they're not making the same profit margins, and unfortunately that's how some developers can go bust. So this is one of the lowest risk developer business models I've ever heard of. What they do is this. They have established relationships with many local authorities, and they go to the local authorities and again they ask them, where is the greatest need for the social housing, sometimes also referred to as affordable housing? Where do you need it? Which towns and which cities across the UK? So having established a relationship, they are one of the preferred providers to build for that local authority, and they tell them. So then what they do is they go out to those towns and cities and they're looking for land, but with planning permission. That's a key issue, because if they get the land with the planning permission, they can pretty quickly start to build. If it doesn't come with planning permission, then there's a risk that things could get delayed in meetings that go backwards and forwards between the developer and the planning department. So once they've identified, what they do is they agree to put a small amount of money, almost like option money, to purchase the land, but they have an agreement with the local government to then sell the land to the local government and make a profit. So typically within about anywhere from 3 to 6 months, what they will have done is they've acquired the land and then sold it pretty quickly on, we refer to as like a back-to-back deal, to the local authority and make a profit. Now, once they've sold the land, they've also had a pre-agreement with the local authority to build the property. And the model is this: as soon as they start building, every month they invoice the local authority for the cost of the build plus a 30% profit margin until completion, which gives them a guaranteed positive cash flow every single month. Now, a traditional developer is relying on the open market and hoping that they can sell those properties as fast as possible for the highest price to make a profit. But what we've seen in recent years is, with interest rates going up a lot, the affordability of mortgages has gone down. People can't afford a mortgage, so the sales has slowed down. For the developers themselves, the interest rates hit them if they need to borrow money. The labour costs have gone up, the material costs have gone up, and again, can cause higher risk for a developer. So with this business model, before they even purchase the land, they have signed agreements with the local authority to build the property with a guaranteed exit, with a terms and conditions where they get paid every single month with a 30% profit margin, and they make a profit on selling the land to the local authority. And they haven't put a penny down of the money before everything has been pre-agreed up front. So when you look at the risk is very, very low, because they've got a guaranteed profit on selling the land, and then they've got guaranteed profit every single month with a guaranteed exit, irrespective of what the economy is doing. And remember, if the economy is going down, there's actually a greater need for the government to be building more social housing. So it's a very interesting business model. Now, I mentioned they had over 25 years of experience building properties, particularly in the social housing and affordable housing area. They've currently got 13 projects on the go, with several completions coming up at the moment. They've already completed on numerous ones as well. And when it comes to social responsibility care, they merge financial opportunities with social objectives to ensure their investments not only generate profits, but also contribute positively to society by enhancing living conditions. Now, what's the opportunity? Okay, well, this really summarizes it. Basically, they are offering fixed income bonds, which start from an investment size of £10,000, which is about 429,000 baht. And in return, they basically offer an 18% interest, which is paid at 1% per month. Now, those who are seeking even higher returns can opt for 21% paid at the end of an 18-month term. So if you're looking for monthly income, basically you can look at 1% per month, and over 18 months, that's going to give you a total of an 18% return. If you don't need monthly income, you can decide to take a higher interest rate at 21%, but it's paid at the end of the 18-month term. Does that make sense? Good. Now, there are some additional bonuses. If somebody is investing a larger amount of £100,000, over and above what you see here, they'll give 1% bonus. And if you invested more than £200,000, they will actually give a 2% bonus above either of the options that you decide here. Now, as I say, they are 18-month terms. with what we call a first charge on the asset, ensuring investment is effectively protected with minimal risk. I'm going to go into a little bit more detail of what that is in a moment. So the Alderley Group really provide what we call a turnkey approach. They do pretty much everything. They go to the local authorities, they find out where the local authority needs the properties, they go out, find the land with planning permission, they sell it back to the local authority, and then they have a contract to actually build the properties, and then effectively those properties are being bought over time back by the local authority. The model reduces risk because it eliminates critical risks, avoiding planning uncertainties, market fluctuations, or sales risks. As I say, it's a guaranteed exit. They already know the local government is buying before they even put a penny down, creating a resilient investment environment for our stakeholders. And they partner with many different housing associations. Here are actually some of the housing associations here. Some of these are managing literally thousands of properties in different parts of the UK. Now, Homes England is actually an organisation that the UK central government last year gave £500 million. In fact, I've heard it's now increased by another 300,000 to £800,000, which in turn is shared out to different local authorities for budgeting to be building their own social housing around the UK. So this is the organisation, you can look them up, that basically are funded by UK government, which is then allocated to local authorities and housing associations to partner with developers like the Alderley Group to build social housing. So let's look at some of the risk measures. A first charge debenture. Alderley Group's first charge debenture protects investor funds, positioning them to be the first in line for returns, enhancing the security of their financial commitment. Now, let me make a comparison. If you were buying a property and going to the bank yourself to apply for a mortgage loan, the bank will look at you and say, well, let me have a look at your financial situation. And if they agree to lend to you, they'll provide you with a loan. But to protect their loan or their liability, they take what's called a first charge on your property. Now, as long as you keep servicing your monthly mortgage repayments, everyone's happy. But if you stopped paying at some point, the bank has the legal right or a first charge on your property to repossess it, and they can sell it off to recover the loan that they've provided to you. In a very similar way, but on a larger scale, that's what this is. The investors actually have a first charge on the developer's assets or developments. It's actually administered by a security trustee, and the security trustee basically acts on behalf of all of the investors. And in the very unlikely scenario that a default occurs, the security trustee, rather than you having to sort this out from a distance, the security trustee, on behalf of all of the investors, has the legal right to then repossess the property, sell it off, and administer the money back to the investors. Absence of senior debt. Well, senior debt, another way of looking at that is bank financing. So the Alderley Group don't actually use senior debt or bank financing for the construction. Remember, every single month they're billing the local authority the cost of the build plus a 30% profit margin. They don't need to go for the bank to get the additional financing. A traditional developer probably, not in all cases, but probably will go to the bank to get the financing. But as soon as they go to a bank to get the construction finance, the bank will take a first charge on the property. So here, because the Alderley Group do not use bank financing for the construction, the investors will always have a first charge over the developer's properties. And what we call robust risk management. The Alderley Group employ a comprehensive suite of risk management practices, which includes insurance coverage, extensions of time, contingency planning, to mitigate unforeseen external factors such as weather disruptions and many other things. So there are various security measures in place if you'd like to invest in a bond where the underlying property is social housing. So revenue expansion, they're expecting or projecting 220 million revenue by 2028, indicating a very robust and growing business. I've mentioned here a healthy built-in profit margin, 30% net margin paid monthly, against a true borrowing cost of 12 to 15%. So this borrowing cost is obviously costs related to paying investors based on the actual profits that they're making. And their financials demonstrate a solid foundation of profitability and sustainability. And sustained cash flow. Alderley Group emphasised sustained cash flow to ensure operational efficiency, fueling reinvestment to our projects and ensuring continued growth and opportunities. Okay, we're getting close to the end, so we're nearly there, hang in there. Okay, community empowerment. Basically, they are helping to chip away at the huge deficit of properties in the UK, promoting stability and security for many, many families. They're creating employment opportunities. So when they go and construct, they're employing local people within the towns and cities. And I mentioned about the ESG and the sustainable practices. Alderley Group are committed to sustainable building practices that not only enrich the community, but also enhance the environment footprint of their developments. So, if you were to look to invest in the property bond with the Alderley Group, the process is actually very simple and straightforward. There is an application form that probably takes no more than 15-20 minutes to fill out, together with the supporting documents of a proof of address and a proof of identification, like an ID card or a passport. I usually vet through that, and if it looks like it's all ready to go, I'll forward it to the developer. And usually within 1 or 2 days, the developer will come back and say that the application has been approved, and then email details of where to remit the funds to. The time it takes typically to turn around the investment, if everyone's working efficiently, is usually about 4 or 5 days. So you can, I can send you an application, and it could be on Monday, I send you the application, and by Friday your investment is live and you're starting to accrue the interest on a daily basis. Remember, it's over an 18-month term, offering, depending on which choice you make, monthly income at 1% or 21% at the end of the 18-month term. There's various documents. I've just given you some very brief ones there, but there is fact sheets, investor brochures, due diligence packs, lots of things. And I found the Alderley Group very good in terms of their communication. Every single month they have a newsletter with updates. Very often those newsletters have links to video fly-throughs, so you can actually see exactly what's happening within the various developments that they're working on at any point in time. Now, this is my last slide, and what I have done here is try to bring together a comparison of investing into social housing, where the left-hand column is the yield investing, that is if you were deciding to invest and own the property, and on the right-hand side, the Alderley Group, which is the property bond, where you're not owning it, but you're lending money over an 18-month term. So let's just look at some of the key numbers. So if you own the property, you're starting with a 9% net yield, which is adjusted upwards every year based on inflation. In addition, you'd be looking at a capital growth over time as well. Social housing, I've mentioned the interest coupon rate is between 18% that's paid monthly or 21% that's paid at the end of the term. These are fixed income products. It's not subject to what the market's doing. It's fixed. Dare I say it, like a fixed deposit. You know exactly what you're going to get from the bank. This is a contractual agreement. It's not a projection. The investment term, well, there's no real specific term. As I mentioned, you can sell the property whenever you want, so you could hold it for as long as you like, or you could participate in the developer buyback. It's 18-month term, as I've mentioned, for the bond. Investment entry level. Owning the property, entry level is about £75,000, which is about 3.25 million baht. Entry level for the bond, £10,000, which is about 429,000 baht. Time to purchase one of the properties is about 4 to 6 weeks. Time to turn around the bond investment, about 4 to 5 days. Taxes, I've already touched on stamp duty, land tax, income tax, and capital gains tax. In Singapore and MY Malaysia, there is no income tax charged if you're, let's say for myself as a Singapore resident, I don't get income tax on the interest paid to me. If I own a property and a physical asset that is in the UK, there is income tax. But on the bonds, interestingly enough, for Singapore residents and Malaysian residents, there's no income tax. Now, I'm not sure, and I do need to find this out, about Thai residents and whether you get taxed. But for Singapore and Malaysians, this is a very, very tax efficient investment because 100% of your funds go into the investment. There's no entry fee, there's no ongoing management fee, there's no exit fee, and again, in Singapore, there's no tax on these as well. Currency. To buy the property in the UK, you're going to be investing in pound sterling. With the bond, the Alderley Group will accept several currencies, the Sing dollar, US dollar, pound sterling, the yen, and the euro. So, you know, depending on yourselves, you may wish to consider investing in any one of those currencies. Of course, whenever you invest outside of your base currency, you are taking on some FX risk. But at the same time, you could look at this as diversifying your portfolio in currencies, but with an investment that's got a fixed term return as well. With the actual ownership of property, who is funding it? Well, the government's funding it, and they're funding the rent. You are the landlord, you are the owner, government backs and pays the rent. When it comes to the bond, the developer is getting paid by the government to build properties for the government, and you are lending money to the developer, who in turn gets funded from the government to build these properties. And the exit options. Okay, well, I've really mentioned this before. You can sell whenever you want. You could hold for as long as you like, keep it for long-term income, keep it for legacy planning and passing to the next generation, or you could participate in the 3-year, I say it's 3-year, I mean, they're trying to speed this up, and the way things are going, they look like they're positioning for an exit sometime later this year, just so you know. And then, because of the client base growing and growing, instead of being 3 years to exit, they're probably going to be reducing that maybe to every 2 years. With this, it's a fixed term. It's 18 months, and once you've come to the end of the term, you could decide whether you want to reinvest in one of the bonds, so you can actually roll the money over. And once you've seen work once, I've had lots of clients who then roll their money over and sometimes even put several investments in as well. So that, I believe, brings me to the end of the presentation. I know it's an awful lot to take in, but let me open up the questions again. I think there's a microphone out there somewhere. Is there a microphone, or do I bring it back? I think, yes, there is. Anybody who has a question, put their hands up and we'll hand the mic out. Any questions, particularly on the Alderley Group and the property bond? I mean, really, when you look at this, 2 different ways to invest into social housing. One might be a medium to long-term investment for people. Usually owning property tends to be looking at it as a longer-term investment. But you can also invest in the same asset class on a short-term investment for just 18 months. And I have clients that do both. There's no right or wrong. in a balanced investment portfolio, sometimes having short-term investments, so there's a bit more liquidity, you can decide to reinvest it through into another bond, but you might find at the end of the 18 months, if you've been saving for a property purchase or some other investment, you could use the funds for that. And I have quite a few clients who have cash, and rather than just sitting in a bank with inflation eroding it away, they'll put it into a property bond, and if it's an off-plan property and it's coming up for completion in, say, 2 years' time, they can then have got their money working for them and use some of that money for the final balance of the deposit. Any questions, though? Yes, please go ahead. Where's the microphone? I thought it was near to you. There you go.
I mean, this all sounds great, right? There's no reason why I wouldn't want to do this, but can you tell me some reasons why I wouldn't? Like, what are some risks for these two schemes?
Well, there's always a chance that the developer could default. You know, I often say, what's your worst case scenario? Your worst case scenario, you could lose all of your money. That's your worst case, I think, in most investments. But let's walk this through. The developer, let's say the total value of a development, let's just use some round numbers to make it easy. Let's say they have a development that when it's fully built is worth £10 million. Now, they don't need to raise £10 million to build it, because remember, all of the construction is being paid for every single month. So the developer is actually raising some funds which they use to put down to help purchase the land. Now, they don't need to purchase the whole land as in 100% of the cash. Typically, we have something like option money where you can put down a deposit to hold that land, and then what they do a few months later is do a back-to-back deal where the actual local authority is buying it off them at full price, so they get their profit margin. But let's just say, for example, they raise £2 million, and I'll just throw it out there. Actually, typically they've told me it's about 5 to 10%, so actually probably £1 million is more realistic, you know, to put down as a deposit on the land and use that to acquire the land with the planning permission. So you have to ask yourself, okay, as long as the developer can build and complete the property, if the development is valued at £10 million and the loan to the investors is £1 million, the value of the property would have to drop significantly, I mean over 90%, whereby if they were selling it, then there's no longer enough equity in the development to pay back the investors. So let's ask ourselves the question, what would have to happen for a property value to go from, in this case, let's say 10 million, worst case is down to 0? And I'll throw that out to you guys. What would have to happen for real estate value to go from, let's say, 10 million down to 0? The only thing I can think of, and it might sound melodramatic, but it's like, well, if nuclear war breaks out, you know, the land is contaminated and probably can't be touched for many, many years. But it would take something really drastic for the value of the asset to go from, you know, in this case, 10 million, so that there's no equity left and value, even when it was sold, to pay back the investors. Now, I showed earlier, records show from the 1960s, the biggest drop in real estate prices since records began was during the global financial crisis, and they fell by about 17, 18%. That's the worst in history. Could it be in the future something worse happens? Yes, it could. But history shows us that that's our worst case scenario. So I always say this, there is risk. And if the risk is too much in your perception, then my answer is don't do it. Life is too short. So really what we're looking at the risk is development risk. What is the track record of the developer to be able to build? Because if they build, the value of the end asset far outweighs the liability. So one of the keys that I look for when I'm looking at these, and I do have several developers that I work with on these kind of property bonds, I look for a developer that has typically got a minimum of a 20-year track record. Now, that shows me that they know how to manage a development company. They've gone through different economic cycles and they're still in business. So that's a good starting point. It's not a guarantee of success, but at least it is a good starting point. So that's certainly one of the things that I would be looking out for from a developer. The other is really, does the development have something a bit special? Is the business model a bit special? Either their business model is much more profitable than a traditional developer. And I said as a rough guideline, a traditional developer in the UK might be making 15 to 25% profits. Or in the case of the Alderley group, I believe it's a very low risk developer model because before they even put any money down, they have already guaranteed the exit. And their payment terms are making profit on the sale of the land. And once they start construction, they get profits every single month, which gives them a very healthy, positive cash flow. So at the end of the day, I think it comes down to each person assessing risk. And I always say again, if you feel that this is too risky or you don't understand it, don't do it. If it is something that's interesting, but maybe you need more of a one-to-one conversation with me. That's why I've mentioned I'm going to be around until Tuesday evening. I might even extend that if I get inundated with people. But I'd be more than happy. In fact, the thing that I'd like to encourage in these kind of seminars is that it's a great opportunity to meet lots of people in a short space of time, but everybody's individual. Everybody's got different questions and concerns. And it's great to ask them because what you may be thinking, other people might be too shy to ask. So I love to promote you asking questions, but I would also encourage you that I'll be around for a few days, and if we can't fit in a meeting in the next couple of days, we'll have each other's contact details, and you can speak with me or my colleagues, and we can arrange a time for a one-to-one sort of Zoom call or video call if you wish. Did that answer the question? Okay. Any other questions? Yes, have we got the microphone still? Okay.
So what about the risk in the investment in the social housing? It looked good, but I'd just like to know, are there any risks for investment?
Well, I believe there's always some level of risk. I would say that the ownership of the social housing is probably the lowest risk real estate investment I've come across. But there's always some level of risk. If I was to say there's no risk, then I think that's a bit of a red flag flying. But there is some level of risk. I would say that there is a certain amount of what I call counterparty risk. Who is paying your rent is probably the greatest counterparty risk. That is the housing association. So the housing association, as I've mentioned, gets paid by local government. In turn, they get paid by central government. On occasions, it's pretty rare, but on occasions, some housing associations have gone bust. Now, they are regulated, and it's very difficult to get a license to be a housing association. But on occasions, a housing association has gone bust. Now, the risk is then, okay, what happens then? Well, in the tenancy agreements, it actually says if the housing association goes bust, the local authority has a responsibility to replace the housing association with one of their other housing associations. So a new housing association would be appointed to manage the property and take over the lease agreement. But there might be a few months between one going bust and another being appointed. So there might be a delay in getting some rent. But you would still be owed any rent that's in arrears. So if you hadn't been paid for 2 months, the housing association should pay for the shortfall of that. So there is an element of risk there. But this is why I say that they're low risk. I'll share another one, and again, this is why I do believe they're low risk, but not no risk. On occasions, a local authority has also gone bankrupt. Actually, a couple of years ago, Birmingham City Council, which is apparently the largest local authority, not only in the UK, but apparently the whole of Europe, and it went bust. It's quite complicated, but they went bust. Now, the Birmingham local authority has housing associations that need rent, and in turn, those landlords need rent. And in turn, the vulnerable people living in those homes need a roof over their head. So one of the few things that central government stepped in and continued to pay was for social housing. Because if you think about it, it would not go down well with the local authority or the government if suddenly vulnerable people were literally evicted out of properties and were homeless. So we see a precedence there in Birmingham City Council when it went bankrupt, that one of the few services that central government paid for was still the social housing. Sometimes people ask me questions, well, what happens when the government changes? You know, I know dare I say, in Malaysia, when a government changes, things can radically change from black to white and from white to black again. I don't know quite what it's like in Thailand. I've seen, you know, I know it's a bit sensitive, but red shirts, yellow shirts, and it gets quite heated, doesn't it? It seems like it's quite heated. Anyway, I'm not so familiar with Thai politics, but what happens if the UK government changes? We've had a recent change from the Conservatives who were in power, I think it was about 12 years or so, something like that. And recently we've got a Labour government in, which generally a Labour government is more pro social support. But irrespective of which government is in power, social housing has been around for about 100 years. And I mentioned earlier that approximately 8.5 million people in the UK depend on social housing. So if you imagine the government suddenly decided to do a U-turn and at an extreme says, we're no longer going to fund UK social housing, and a new policy is out, and now you're going to have to find your own homes, you would literally have 8.5 million people on the street. And I think that would cause some major chaos and protests, and it would almost certainly be the end of that government because they're not going to be very popular. It's certainly not an ethical thing to do as well. So I truly mean this, is that when I look into the risk of this, yes, there's always some level of risk, but I think it's very minimal.
Are there any chance in the future there's going to be like an oversupply for this?
Social housing? Well, JLL estimated, now I think it was something like in the next 10 years, they estimate that the waiting list will go from 1.33 million people to 2 million. And every single year there is a deficit of about, or the need is 90,000 homes. The number of homes that are required at the moment for social housing is literally in the hundreds of thousands. And based on history, you know, I was saying right at the beginning that I think in 2020 the number of new social housing homes delivered in that year was 6,000. And it really isn't increasing that much over the years, yet the waiting list is going up. So it's actually getting worse rather than better. I truly believe in my lifetime, you know, whether that's another 20, 30 years, I don't think it's going away in my lifetime. There is such a huge demand, which is only getting greater. Any other questions? Okay, all right. What I again would like to encourage, I've got a name card if anyone wants my name card. I have my contact details. They're in several different areas of the handout. My contact details are in there. I'm hoping that today has really given you an opportunity to understand about a different asset class. The one thing I ask in return, apart from your time, can I just take this? The one thing I would like to ask you just to spend a moment to do, this is called an expression of interest. There's absolutely no obligation. Now, if you walk out of here and say, Richard, this is absolutely not for me, that's fine. Remember, I deal with many different forms of real estate investment. And if you'd like to speak with somebody who's very knowledgeable about the UK real estate market, we can talk about many other things. So if you're looking to buy a property in London, Manchester, Birmingham, wherever it may be, I can help you. I've got hundreds of those properties in both brand new build and secondary market. So even if you're not interested in this asset class, do still fill it out, because there's a comment section at the bottom, and you might say, well, Richard, thanks very much, not interested, but I would like to have a chat about some other investments. Maybe you've already invested and you'd like some feedback on tax issues. I'm not a tax advisor. It might be, should I buy through a company structure? What's financing options available? What's refinancing options available? How could I remit my money more efficiently? I work with various FX remittance companies that are far better than most banks. The list goes on. In fact, I would like to feel that I'm a solution provider. Real estate is the asset class, but around real estate, there are lots and lots of other things that I can value add to a client. So I've shared about social housing because I said many people have never heard about it, and if you are looking for something that's low risk, high yielding, or you're looking for something that's giving an attractive interest return, which is a shorter term investment, and watch this space, because later this year I'll be sharing more and more different kinds of real estate investment strategies that might be suitable for you beyond just the traditional buy-to-let investments. So please just spend 1 minute to fill this out. The comments are really helpful at the bottom. And as I say, if anyone would like to meet me, I'll be in this part of Bangkok until Tuesday evening. I will stay longer if there's lots of people. And we can either meet up here at the W Hotel. There's quite a nice looking Starbucks in the building next door. I saw with sort of like a glass cone there. So wherever you know, but I'll meet, ideally if we can meet in the centre of town. I'm staying down this part of town. And if we can't meet physically, one-to-one, then if you'd like to have a chat, we can have a telephone call or a video call. Okay, so fill this out and either hand it to myself or one of my colleagues on the desk outside or here. And if you want to hang around for a while, I'll be here. So if you want to have a little bit more of a chat over the next half an hour, I'll stay around.
We did